Put ratio backspread. Hi everybody, welcome to Trading Board. In this chapter, we went over the call ratio backspread strategy in detail. The put ratio backspread is similar to the call ratio backspread, except that the trader uses it when he is bearish on the market or stock. This is what you will experience when you use the put ratio backspread in general. If the market falls, you will make an unlimited profit. If the market rises, profits will be limited. A predetermined loss if the market remains within a given range. In other words, you make money regardless of whether the market moves up or down. Of course, the strategy is more profitable if the market falls. Choose an ITM and OTM strike combination regardless of the time to expiry. When there is more time until expiry, an increase in volatility is beneficial to this strategy. When your outlook on the stock/index is bearish, the put ratio backspread is best executed. The strategy requires you to sell one ITM PE and buy two OTM PE in the same ratio, i.e. for every one option sold, two options must be purchased. The strategy is typically used for a net credit. The strategy makes a limited profit if the stock price rises and an unlimited profit if the stock price falls.